Well, it doesn't get any bigger than this. Not only are we in big earnings week, but we've also got tons of economic news coming out. On top of that, trillions of dollars of options are expiring this week, and we're going to see some massive moves. But what about Tesla? What about Netflix? Well, it's all about margins. Now, suddenly, fundamentals do matter again. And in a time of high interest rates, markets are starting to freak out. You can see here 2 big days of selling. Is there a little bit more to come? And will we actually see a rally into the rest of the year? Well, we've got the data stats going over the last 40 years that show us what tends to happen in this week in today's video. So will volatility continue to spike? And more importantly, what happens to the 2 biggest tech stocks this week in Tesla and Netflix? Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everyone to The Daily Show, where we talk about markets around the world. This is the special weekend edition, and if you like anything to do with macro, lead indicators, or the hottest charts around the world, make sure to subscribe and of course smash that like button. Well, as we mentioned in the previous video, we expected a spooky Friday. Friday the 13th in October tends to be a negative session. The answer was, it certainly was. However, it wasn't in every sector. Energy and gold did very, very well. But more importantly, what does that lead us into in terms of the data stats? Well, we've got a few to talk about here, including volatility moving forward. First up, do we expect a sell-off during this time of year? The answer is quite simply, yes, we do. Do we expect it to be recovered? Generally, we do, but we need to talk about that a little bit later on because there are some indicators that are starting to look a little bit shaky. So what happens? Well, in similar years such as this, where we've seen such strong runs at the start of the year over the first 7 months, we tend to get 100% positivity by the end of the year session. Now, that's just a data stat, but here is what happens in weeks such as this: options expiration, OPEX, and trillions of dollars. Well, it turns out that we have a pretty positive stat: 30 up and 10 down for this last 40 years. And it shows us that you need to be thinking about the markets as possibly giving you a little bit of a false read at this stage. Maybe it's a sell the rumor, buy the fact type of situation. Now, why did we sell? Well, there are many options and many kind of explanations for why this happened. You could argue that it was most profitable with another big options expiration just last Friday for it to expire exactly where it was. They actually managed to get maximum pain to the T. But the question then becomes, what about this? Why was everyone so bullish and so little people were confused? Yes, neutrality went to 23.5% in the surveys, and it usually sits around 31.5%. Bearishness was still pretty high, but the bulls came back in massive force, and it shows you the type of market condition that we're going to be playing with most likely for the next kind of 12 months. Up, down, and all around coming into elections in the US. Bull-bear spread went back above zero, and it kind of was timed for us to see a bit of exhaustion. And we mentioned this on the channel, and it turns out we all got it correct together. But what about earnings season? Well, it looks like the boffins still believe that everything's looking better. In fact, forward projections for US earnings are rising again. And oftentimes you can kind of use a chart like this to say, well, that's where the market should be at fair value. Now, we've seen overvalued and undervalued markets over the last kind of 24 months. But at the same time, yeah, we're pretty low in comparison to where this forward EPS is. But they can revise it with a snap of a finger. So just remember that what their expectations are aren't always correct. Let's look at some evidence together. First up, we saw smart money, which is this blue line here, starting to drop positions late last week. Well, it turns out they were smart again, and while retail was buying up heavily, smart money was kind of dropping a little bit of profit, and we've got kind of some evidence towards that with dark pool transactions coming up later in today's video. We also know it is expected, based on bullish percent index and other things that we cover, to have some type of pullback even if we are in a recovering market. It doesn't always have to go full on V-shape. Often what will happen is we'll see the recovery, we'll see a drop back to allow other people in, and when it gets kind of scary, that's when you'll see those people buying the V or buying the dip in this case. So is this expected? Well, the answer is yes at this stage, but we will need to be looking at some key indicators because the bears may take control if this earnings season doesn't live up to expectations, if it turns out it's worse than you think. Now, this week is a big one, but it gets even bigger over the next couple of weeks. So make sure to subscribe and we'll cover all of these together off. But Tesla and Netflix are pretty much what most people will have their eyes on. It looks like the banks did pretty well. They're all cautioning against some kind of, softer market environment in the future. But JP Morgan and Wells Fargo and all the rest, they were doing pretty good. We've still got Bank of America and Goldman Sachs. And all importantly, we need to know what is the expected move of each one of these positions based on options markets. Well, here they are. And you can see here that Netflix is expected to move probably about plus minus 9% on Wednesday. Tesla is about plus minus 7%. So that means that if you're going to trade these pairs, get ready for some big gaps during the earnings season. And of course, always be prepared and have that risk management in place. It's great to know what the options are doing. Now, I want to mention treasuries. I'm just going to keep saying this because I do think treasuries had a pretty good recovery on Friday. But more importantly, just remember they are technically oversold at this stage. And you might say, well, Tom, they've been oversold for ages, man. Well, not based on some statistics. It was oversold, then we saw rallies, then we saw recovery, then we saw, of course, now a big dumping. So we're underneath the 200-day moving average by 2 standard deviations, and that's something to pay attention to. We did bring up some dark pool trade activity last week, and we kind of speculated that they were probably short-dated shorts, and it looks like someone has closed one of those near the Friday close. So SQQQ getting a decent transaction on it right at the end of the session, taking some profit off what was a pretty good short. And you can see here they were pretty quick in terms of in and out. That's fairly normal. Now, they're not all out yet, so we'll have to continue to pay attention to that. But does look like some people were cleaning up some of their shorts. Here is the Direxon Daily S&P 500 Bear 3X shares, and you can see another decently large transaction. So when we look at the technical analysis a little bit later on, we'll have a guess what we are kind of looking at from the current structure, but it does look like on the smaller time frames, there are still bears in control. The Treasury bonds did get some more transactions on them, and I still maintain that I think that someone's trying to build a position. But do remember that when we trade Treasury bonds, or if you are someone that trades Treasury bonds, that tends to be really, really tough trade. Instead, it is more likely an investment by most of these big funds as they move into positionals. And you just got to remember it's a different beast when you're trading bonds or investing in bonds than stocks, commodities, cryptos, any of those types of things where there's a lot more short-dated profits. Was it a big Friday in options expiration? The answer is yes, it was, and expect this Friday to be even bigger as we look at maximum pain later on. Almost 44 million options. Have a look at this. 51% calls, 49% puts. Such an even spread. Something we haven't seen that much of, but it does show you that even when the markets are going down at the moment, people are still turning bullish. So there might be a little bit more wiping that needs to occur before it starts to turn around properly. Look at these unusual options activities. Quite a few coming through, and we're continuing to see, some massive puts. In particular, I think on IWM. Have a look at this. 1.2 million almost puts to 443,000, and that's on the calls. I would say that puts are starting to get stacked all over the Russell, and it's starting to make me think, do we have a base down here? And again, if we see a turn in the S&P 500, where we probably will see some of the tech stocks go first, as per usual, and some of the other stocks, man, the Russell could be an opportunity in the future as a technical trader and as an investor even to have a look at those levels and to, of course, look at the risk, look at all those types of things. What other notables were they? Well, of course, anything to do with earnings is going to have massive transactions on it. JP Morgan put in a pretty good earnings season, 4.78 times relative 90-day volume, and that was significant amount of calls coming in on that side. Let's take a look at what really shined though on Friday, and it was the shiny metal itself, gold. We've been bullish on gold, but I've got to say I didn't expect 4.36% on the Friday session. It's nice to see gold making a massive comeback, and a lot of this has to do with yield curve changes, instability in the world, all sorts of things going on. Notice something else though. Not only did we see energy up, which of course is more of an inflation-based thing, but we saw the defensives actually showing us some strength here. Utilities, okay, that's been strong the last couple of days after a brutal sell-off. Staples and healthcare. With gold, that's like the 4 defensives. So if they continue to do well as we sell off here, it could mean actually that it's a real sell-off. And we'll be paying a lot of attention to that because at the moment, it kind of looks like it could be just a drop into a potential opportunity. Here's the last 5 days. Again, gold doing incredibly well. Utilities doing really well, as we've mentioned on the channel several times. And energy coming back to a resistance on the charts. So, it's a key level here. And of course, we expect spot oil to go up a little bit more, which we'll talk about now that we're getting into the charts. First up, we always want to be looking at yields. Yields are key. And for treasury bonds, they were pretty happy about themselves. We saw that incredible spike in yields. Then we saw a massive drop back off on that on the 30-year. The same thing was happening on things like the 10-year, which you can see here dropped pretty significantly, and the 2-year as well, just kind of holding around as best it can. So we'll be watching yields. And remember as well, everybody, if it's your first time here, we want to be watching that US 2-year versus 10-year to see whether that gets underneath 1%. And when that does, we can kind of mark a period of time before a recession generally gets called. And usually that's quite a few months still away, but it's something that we'll be paying attention to, I believe, throughout 2024. Let's have a look at the MOVE index. This is the volatility of bonds that was spiking, but I think what was more important was the spike through the VIX. We saw a large spiking, and this could tell us that we could be going into a capitulation move. And while that may not even make a new low, the VIX finally getting above 20 would be a big deal. I mean, here is 20, and here is, of course, where we're at. And if we get above there and we get back to a 25 or a 30, well, that's the kind of type of capitulation that we usually want to see. And that usually brings with it as well, lows, good levels, and really good levels on market strength as well. Have a look at these market strength indicators. So we saw 20 moving average really recover up. Then we've got here the percentage of stocks above the 50-day, which still remains under 30. And I think the one that's more interesting, or the one that probably looks the sickest in the market, has to do with breadth, which is the percentage of stocks above the 200-day moving average. Yeah, it's so bad. You can see it's really coming down to 32.71. So for bulls, they're going to want to see recovery next week, and then realistically this moving in particular. We want to see that rallying as the market rallies. And if it doesn't, and it's only a few stocks, that's really not going to be very well thought about, and obviously not a great type of time to be a true bull in the markets. Could be a false rally. Let's move over to the S&P 500 and the Federal Reserve. As I've mentioned several times, what is this question mark? Wow. So much injection from the central banks around the world, both central banks in the world and the Fed injecting hard. Something broke. We don't know what it is. We didn't get told. But every time the US yields, like the 10-year, 20-year, and 30-year were going up, we keep seeing these types of injections coming in. And they keep claiming tapering, but you know what? It's just not true sometimes. There is taper, but there's also injection. And that could help the bulls. And probably it's the biggest case for why the bulls are winning so much throughout this year. And you're like left scratching your head saying, how could this even be with everything going so bad? A lot of it has to do with something breaks. They bring in the big guns and they get basically just go, oh, hey, it's all good. We'll sort that out for now. Short-lived processes, and I'm sure it'll come back to bite us all in the future. Let's move over to treasuries. They had a pretty good recovery, and you got to like what you're seeing on treasuries at this stage. Obviously, everyone else hates them, which is when I like them. We definitely as a community thought that 88.90 was definitely a pretty big level for it, and it just came through, and they were looking for structure build. Now, we've seen massive volume. We've seen small time frame structure build, but it may take a while to base this off. A lot of people think that they're trading treasuries. It's just not the best idea. It takes ages to base off such a big sell. So because you've got these 30, 40, 50% sales, you've just got to remember it takes a long time to do that. Let's now take a look at copper. Does Dr. Copper tell us anything about the markets? Well, it's showing us that maybe not all is well. We're not seeing recovery in copper. Again, this starts to make new lows. That's not really good for the stock market. It's not really good for the health of the economy. And it's showing us some worrying signs there. Dow Jones Transportation Average Index as well, absolutely getting destroyed on Friday, down 1.76%. Is there a new low? The answer is no. Do we really want a new low? Probably not if you're a bull. You really don't want this one to go too much lower, because you're looking for a recovery. You're obviously looking for the Dow Jones Transportation Average to go up. Same thing with home builders. We want home builders to recover. Are they? Well, the chart looks like it's kind of like a very important point for them. So again, did we see the turnaround? Well, we didn't quite get our 78 that we wished for, but if we had, I would have been a lot more bullish on this run. And these types of things do matter when you're stacking the evidence or confluence in your favor. Now, let's move over to the US dollar. The US dollar was up. A lot of people are left scratching their head saying, how'd that happen? Well, a lot of people going for safe havens in the uncertain world, but at the same time, this is the kind of recovery that you expect. Now, we didn't manage to really get back under this key level that we discussed last week. So therefore, if sellers are going to come in, this is exactly where they should come in, as is caused by, a kind of distributioning market. But I'm not going to go against the US dollar or anything at this stage. I still think the trend is mostly up, and we can't really go against that until we really blitz this level down here, which we spoke about now for about 2-3 weeks. There have been some great currency trades, though, against that and with it. Here's gold, and this is why we were confused last week with taking any shorts. Obviously, we talked about this zone being potentially a resistance or a supply zone, and now gold has blitzed. I mean, that was a huge day for it, 3.42%. One of the biggest days on gold we've seen in ages. The shiny metal went ballistic, and it went straight into that previous level. Now, I wouldn't go against it again, but if it did show structure here, I would expect it to maybe cool itself around this level. It may even run into sub 2000, like 1980 or something like that. But it's kind of like what we've been speculating on. Gold is semi-underpriced still, especially gold stocks, which we've been discussing, and they're still not even at their next targets, which is 29.80. So yeah, gold absolutely flying at this point. Another commodity that was doing well here was oil. Oil recovered off that really questionable, well, not questionable, but certainly tight spot for it. We talked about this being the buy zone for bulls, and they managed to pull it through, and now they're moving it towards potentially the bear zone. 89 to 89.50 is something we've talked about now again for about a week, and we've been basically saying this is where we expect the bears to rekindle the shorts if they're going to do so. With the uncertainty in the world, everyone's turning bullish on oil, but at the same time, I'm going to go with up around this point period, regardless of our opinions, there should be some kind of technical bear sitting around there. Let's move over to Tesla. Big earnings means undoubtedly this week is less about technicals and it's more about the fundamentals for once. And that means that we're sitting around 250, which is expected. 250 is a big key level, psychological zone. I do see that there are buyers potentially around this 250, which we discussed again several times. And this is where, you'd hope to see a little bit more of a rally. Maybe you'll be here before earnings announcement. We'll find out. And if you're not and you're kind of starting to float down, it's all going to come back into earnings. So it's going to be a very difficult one. Are we outside of the ascending channel? The answer is yes. Are we at 250? Yes. Is this where you kind of expect maybe a buy to be? Sure. But when you take a look at a daily, did they get any wick buying there? Not really, yeah. It was just pretty much just like sell straight into the end of the session and sit it right in that zone. So I think there's a little bit of toughness here for Tesla. I'd like to see maybe another day trade, or maybe just go into earnings and then reassess it. As we always say, patience, react, don't predict is the best thing here. So in this case, a reaction off the news, I think is going to be probably the best read on Tesla trading for this week. We'll look at it later on this week. And of course, we'll update you then. AAPL, this is a good sign for the bulls. Did break through our 180 level. So this is huge. And the 180 level, we believe, is a big turning point for Apple, and it kind of points towards sell-offs in this market being met mostly by bull demand. So we're pretty keen on Apple on the pullbacks here. Everyone else hates it, fair enough. But the bottoming was good. We obviously thought there was already some strength here. And it does mark out, though, that there could be a couple of extra percent to sell off first. If we're seeing Apple, let's say, weaken another 3%, it wouldn't be outside of the ordinary for it to do so and still find strength. Interesting point, though, for the biggest stock in the world. The weekly looks pretty horrid, as you can see here, the rejection wick. But let's go through a few others. We've got Amazon here, again, very similar. A little bit of a rejection, a little bit of a rejection on Google. Microsoft is kind of similar, a little bit of rejection, and Nvidia is the same thing. So a lot of little sell-offs. It is important for the bears to take advantage of this and keep selling and selling and selling. I'm not sure if they'll be able to just yet. Let's move over to utilities. Very strong pickups here. Great, big, strong weekly close. As we know, this is an oversold market at this stage, and we've kind of speculated that it might have put its low in for the time being. Energy back at resistance. So again, as we're hitting around these levels, we expect oil to potentially come and drip into that resistance zone where we've seen, basically maybe sellers 89, 50, 89, as we mentioned before. And then if they're going to sell, all of them should synergize together. Remember, most of these markets are connected, so that's what you're looking for a lot of the time. So energy stocks coming into a key zone. Disney, nothing much. This is something that we've been watching, and it looks like it may have based. Now, for Disney long-term holders, even though the stock looks pretty horrible right now, it has sold off to this significant zone. And this marks a very important level for Disney to show structure. So we'll be watching that. What about small caps? Well, small caps continue to be a little scary in the markets. And you can see here ARK trying to test those new lows. Now, we kind of thought that maybe ARK might find a buy here. What you often do is you've got two choices in trading. Either you make a prediction after you see a reaction and then you say a level, I'm going to buy it there, or you find the level and then look for a turn. So in this case, we haven't seen any turn yet. We'll continue to watch RK. RK is not exactly the best read. Obviously, we're looking at the Russell, we're looking at small caps, but you can see here they're pretty much the same thing, coming right down and testing those lows. So now what we can do is we can get that most traded zone. We'll just put this daily level here just for an example. And I'd like to see, some strong buying before we're really going for the Russell. But I think if it does find strong buying, it could have found the low. And we know how important this low is. Let's look at the weekly close just to get a bit of an idea. This is a dangerous weekly close. This for bears, they're going to be looking at this and thinking, yes, I'm going to get further sell-off going through next week. We're going to take these lows out, and then we're going to find out whether we get a short squeeze or not. This is going to be such a pivotal chart. I think Russell needs to be watched. We're going to watch Russell. We're going to look at it like a hawk, because if the small caps keep failing, it shows us something very worrying about the economy behind closed doors. Let's move over to the ASX 200 for Australian traders. Looks pretty good. I'd like to see pullback into strength. Again, this is very similar to the S&P, which we'll be looking at in a moment. German markets sold those massive rolling moving averages and previous resistance becoming support. Interesting point for the German market. Again, if buyers are going to come in, they usually would come pretty much right here. No signs of that yet, but we'll be looking for smaller time frame recovery. German market at that zone. The Chinese market having massive volume trades all over it, but at this stage, maybe it's found a base. Again, speculation over plenty of boosting of the economy, and I'm pretty sure that the central bank will continue to bring some form of stimulus every kind of month now for a while so that they can try to support the economy. Let's move over to some of the tech stocks. Now, first up, NASDAQ. And NASDAQ sold off and actually did it in a perfect way. The S&P 500, the US 500 was the best trade of last week in terms of just absolutely beautiful trading. If you're interested in finding out any more about how you could have replicated that, you can jump on over to the links in the description down below and check out the Day Trading Masterclass. True replication was had last week with quite a few trades. But more importantly, we've got that kind of structure. Now, some of you would say, well, look at this. It's a head and shoulders. Got left shoulder, head, right shoulder. Well, if that's true, then of course, what would you do? You would take the trend line, you would extrapolate out the movement. You would then say, okay, well, it can go a little bit further. Now, what that's going to mark you in on is this down here. And you're going to see a lot of people kind of marking out 14,850, 14,800 and saying, that's where I think the sell-off's going to go to. At this stage, with the available evidence, you would say that is more likely. Even if it does rally, it probably sells straight back into that zone. And you're thinking somewhere around here. And it's going to be the same on the US 500. So if we have a look at the S&P, first up, we go to something like the daily. You can see here, didn't quite close on its low. Again, 20 moving average. This thing has been absolutely beast mode for the markets. You've seen selling, you've seen buying, you've seen all sorts of things. Then you've seen here, it's holding above it. It drops this level, where to next? Maybe 42.80. Let's have a look at the futures market and understand also what's going on with maximum pain and the options. So I think 42.80 probably marks a pretty key zone here for the S&P. Somewhere in this structural level is where I could see some buyers trying to buy the dip. Again, was this an excellent trade? Yes, it was super excellent and super replicable and super awesome. So yeah, very, very good trade, good shorts on the small time frames, and we kind of expected it after the exhaustion. So will we get a little bit more? Well, some of it speculates yes, but by the end of the week, maybe not. Remember, we've got that 40-year stat, 30 up, 10 down. On top of that, what about maximum pain? Well, maximum pain sits right around where we are right now. Now, we mentioned 42.80 before. Have a look at these puts. What is this? This 420 may be too much for the market to get through. Now, never say never. Of course, none of this stuff is ever guaranteed or anything like that. But you've got a lot of options expirations. As you can see here, you got 420, just huge amounts of puts. And I expect puts to start stacking some of these levels. 425, 430. Look at these throughout the week. We'll be updating you guys as we see fit and as we see them. Also, 440 might be a little bit hard for the market to get through. So we've kind of got like a range between 420 and 440 seems likely this week to be traded. And I kind of could see like weakness into potential strength. And that would mark, very, very normal kind of way that the markets would trade. So something that we'll be continuously updating. Make sure to subscribe and, of course, follow along. What about crypto? It's boring, guys. I'm sorry, crypto people. It's boring. It's paint drying. And it'll get exciting. I reckon 2024 is a good year for the crypto fam. But at this stage, we have nothing much going on. It kind of looks like it could be flagging. Who knows? If it is, then 26,000 is going to get broken. That's, of course, where the last buyers are at this stage. And if they don't hold that level, then we're going into a swing trade towards the short end. And Ethereum, obviously, we've already talked about this several times. I don't like this chart. I think it's trash. It actually took the low the other day. The recovery was, I don't know, lackluster. If you were going to be a bull, around there would have been the zone. And, it is what it is. It is what it is. I don't really like the Ethereum chart that much. Let's look at economic news for the week ahead. So first up, we can go through here and we can kind of scroll through and see what's going on. We've got some CPI coming out for CAD. We've got core retail sales for the US, which will be, I think, pretty important for this earnings season as well. And then we go through and we obviously see unemployment claims, Fed Chair Powell being annoying on Thursday. So that's always good, 12 p.m. New York time. And then some more retail sales throughout the world. So this week really comes down to earnings, and it comes down to continuation of seeing the banks doing okay. It comes down to what is the future expectations of these companies, and probably a lot of it rides on Netflix and Tesla. So make sure to be on top of that, because that will drive a lot of what maybe the Magnificent Seven will do as well. And as we know, it's all about tech when you have most of the market being run by tech right now. What is it, a 28% saturation or something? Some massive amount. If you enjoyed today's video, remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.